As you see, we don't care what happens in the market. It's the biggest crowd we've ever had, which is pretty bullish. We've got 220 people here, biggest turnout we've ever had for a conference. So yeah, very happy. The first presentation, basically how to build a long-short portfolio from scratch, showing them all the best disciplines of how to do that, and showing them examples of traders in the institute and how they've actually done it with their P&L, all their positions, how portfolios were built, and the money that was made. During the entire lifetime of the trade, he was down 7,800. That was the worst situation. And the profit was 307. So the max loss to max profit ratio is 41. Ridiculous. This is why we have these guys trading on money. Now think about the question that we're going to get asked probably all day long and at the bar later. Anton, why do you do it?
Here's a little trick. If you open up your portfolio and you always check one stock first, that means you have too much risk in that stock. It's true. Remember, you have to notionally adjust your risk in option trades just like you do in stock trades. And that's why a lot of, even hedge fund traders, that's one thing that a lot of them don't actually understand. They know how to trade stocks, they know how to build out portfolios of stocks, but as soon as they trade options, they kind of lose that skill. So you go through the option chain, and if you see the one that says 57.5, to the right of it are puts.
Lovely day here in New York, and everything's good. I'm just about to start again. I'm talking about high risk, high return trading, and one of the things that we're stressing, I'm going to talk about now, we all touched on this morning, is idea generation. I mean, I think we give you the process to generate ideas. I think that's one of the things about the What's in Your Mind series and some of the videos that we've been putting out. It's all about idea generation, and I think we just look at the quality of the ideas and take it from there. Now, this is a nice little chart. Again, going back to charts, that looks to me like the formation of a head and shoulders. Now, I've got no idea. Do I want to see that because I'm bearish? Yeah, probably, yeah. So I'll be very, very careful about saying that's a head and shoulders pattern. You can see what you want to see. So how do you trade this?
But no, seriously, in terms of safety, we think about things like the US dollar, US treasuries. That's a much better way, or I think it was Chris that mentioned S&P puts. That's a much better way to look for safety. But no, we don't have fixed cash allocations. It's opportunity driven.
Yeah, at the back there.
What's your take on the gold miners?
Say it again.
Which one? When you say the gold, do you mean the gold miners or a gold mine?
As far as hedge.
A hedge against what? A hedge against making money?
Yeah, I think very well. I think we had some great questions. Just a natural kind of discussion amongst the four of us, with some pretty good retail trading questions. It's one of those things where it's not just keeping me engaged in the market, but it's also fun. We get to do things like this. You can see from our CVs, you can look up our regulatory histories, you can see that we've actually worked for institutions and run money flows institutions. The difference between that and somebody just rocking up, having traded their own money for a bit and pretending that that's the basis to give somebody a good education is obvious. Almost certainly in the short term, what is happening is that the target company's share price is going down. So let's think about Monsanto, the agreed takeover offer, 44% premium to the undisturbed price.
So what I want to go through with you guys is a simplified model for M&A valuation. The idea is that by running through an example or two with some numbers, it's going to help you understand what you need to be thinking about in terms of taking a position through the acquirer, like Jason was just talking about.
Home run knockout trades for 2019. It is a bit too much information to take in and write notes on. These are very good hedges against consensus positioning in the market. So you can pretty much get a 4-for-1 reward to risk if you're doing that now, 6 months out?
At a real interest rate of 0.25% earns you $250 a year on deposit. That is financial repression. That's the point. It's designed to get you to go and do something else. You can complain about it. Guess what? It's the way it is. In my opinion, and most of the other mentors' opinions, the only way in a zero real interest rate world to get ahead is to take some calculated risks. Everyone in this room has done something, i.e. getting off the couch and making their way here, that 99.99999% of people who watched our films couldn't be bothered to do. Most people can get there. The people who don't get there are the people who can't be bothered. Take a risk, take a calculated risk, and do some work.
So we just did a super conference in New York City, my hometown, the biggest one we've ever had. The quality of the other senior trading mentors are outstanding, and I especially enjoyed our Q&A panel with me and the other three on stage at once, answering questions about our life and our careers. I think it was great for students to ask one question and basically get 4 answers. And I really think the students got so much, not only knowledge, but just to meet like a group of other people that are going through the same experience. And hopefully we'll stay in touch and learn to profit off of each other.
Our delegates today have gotten, I think, a very broad gamut of financial information. They've got some equities, they've got some valuation techniques, they've got some momentum trading strategies. We've touched on options, we've spoken about macro, we've spoken about FX, and we've given real-world examples of retail traders who've been profitable. I've enjoyed it, and more importantly, I think they have as well.